say you're looking for anti-crowded factors, that might be interpreted as you're looking to arbitrage crowded traditional factor plays, but I don't think that's quite what you mean, right? So
yeah,
maybe take us through more.
Arbitrage is the wrong word, but like if you kind of go like, look, how do you make money in this world? Like how do investors make money at a very, very high level? And this is going to be crazy simplistic and probably wrong, but I'm going to go with you have to be early and or you have to be different. Because look at it the other way, right? If you do the same thing as everyone else, if you literally have the exact same portfolio as the average person, you should expect median returns. That you cannot expect to outperform to do the same thing as everyone else. If you do the same thing as everyone else and you get there late, you should expect to underperform. And so the key, I think the key to alpha in this world, the key to outperformance is early and different, or early or different, if you can do both of them. And so what we're trying to say is like there's two sources of alpha for an allocator, right? There's your manager's alpha. And so I can say as a manager, what are we trying to do is like we're trying to be early and or different across the board, or we're trying to stay away from crowded. Like you have to stay away from the crowded trade or you have to find the uncrowded trade. And so what we're really trying to do is that you can either anticipate flows or avoid crowded positions. And in both of those cases, and once again, crowded positions can be imputed lots of different ways. Like we do it from looking at our own internal model suite and going, where is this fully crowded? We can anticipate it from. We have one model it literally has just a bunch of trading rules, and they're kind of nonsense on their own. There's a whole bunch of trading rules. I have a whole bunch of different utilities and a whole bunch of like agents that we simulate doing their thing. And if you just follow the trading rules, it doesn't really do anything. But the real key is like as those trading rules interact, when do they get crowded, and what are the implications of that crowdedness? How can I lean against that crowdedness when it happens? And so we're not just going after the systematic crowdedness. We're trying to capture the best of our ability, like lots of different sources of crowdedness. And then, of course, the key feature in all these is that every single one of these models starts with a story to myself, a thesis, right? And then once you have that thesis, we start going to look for it. And then, if there always is a dynamic part to it, which is like the bones of the idea can be very, very stable, but you have to make sure you're constantly adapting, adjusting, because the market is not stable. And the instability of the market, of course, shows up in volatilities. You have to always be adapting volatilities daily to adjust for assets change. The instability shows up in betas. Betas are if something has changed, if you talk about what has changed in the last 10 years, like volatility vol is way higher, right? I mean, if you look at like lots of different ways to look at it, the crash, take 87 out of it for a second, but like 2000, 2003 was like 3 years, 2008 was 6 months, 2020 was, 2 weeks, very fast, very ferocious. Vol has gone through the roof, but also like the betas of interactions of things that used to be uncorrelated have suddenly become far more correlated. And the speed of that change has changed as well. And not only has it drifted higher, but the movement of those betas are much quicker. And so like one of the major sets of efforts and transformations is like, how do I keep these ideas uncorrelated? How do I keep my assets within my models uncorrelated, which is obviously a huge fight. And then how do you keep the models themselves uncorrelated to each other? Because if pockets of a bunch of models, they're interacting. And what happens if 9 of them go long S&P? What happens if 14 go long S&P? What happens if 20 go long S&P? And how do you handle that?
I was going to say there's only there's only a certain number of markets, right? You're talking about 20, 25 different models, but they're all interacting with a small universe of markets, right? So
right. So here's the thing:
being able to look at the overcrowded trades.
When you start with markets classes. on the left side, you've got stocks, bonds, commodities, FX. Vol. I don't know. You can put a couple of, but let's just say like roughly speaking, those are your liquid assets. I'm going to call that 2.5 asset classes. Or 2.5 risk premiums there. Because stocks are a risk premium, bonds are a risk premium, commodities. I'm not convinced the long side to commodities is a risk premium. And maybe a bit, but I'm going to say not necessarily. Like I said, the risk premium to the farmer or the risk premium to Kellogg's, who knows? It can be either side. And then FX doesn't even have a long side. You can't talk about the long side of FX. So there's obviously risk premiums within these things, but there's only 2.5 assets. Now you break commodities. I think commodities is a complete misnomer. It's like commodities is like saying stocks and bonds. Like it's got at least 5 kind of different things inside it. So maybe commodities is. If you look at that set, let's say I got 7 assets. It's a bit of a stretch, but let's say you got 7 kind of things there. The interesting thing is once you start to transform things through models, they become more diversified. You get more effectively independent assets, right? And if you think about trend following, right? Like trend following, if I got let's say U.S. and Canada equities are 80% correlated. I can tell you with certainty that after you trend follow U.S. and Canadian equities, their correlation is less than 80. I don't know how low it is, but I can tell you it's less than 80 with 100% certainty, because there's only two cases. If your trend following model is like exactly for like, you know, every time you're long S&P, you're long Canada, and every time you're short S&P, you're short Canada, you have the exact same signal for both of them, then you're going to be 0.8 correlated. If you're ever long S&P and short Canada, or even like half long S&P and like full long, anytime your signals are a little bit, you know, disparate, the diversification of your signals kicks in, and the correlation between trend followed S&P and trend followed Canada is below 0.8. And so what you see is as you run things through these transformations, these models, you end up with a more effectively independent asset. So maybe you go from like really what's more like 4 or 5 to maybe like 10. Now, if we're doing a second version of that, now I'm going long short trend following, which is going long short S&P 500. And you got a second generation. And what you'll see is the average cross correlation term of your assets as transformed through a model comes down again. And so you get more and more effectively independent things to play around with. And so that's a huge boost to diversification benefit.